today on VIX. Option Pit is a very well-respected authority on the VIX, and so we're delighted to welcome him, and let's just give him a welcome hand.
Thanks. I really appreciate you guys having me here, and we're going to talk about the VIX and the VIX ETPs. I kind of talk about everything they do, and then I will also show you a couple trades I do in VXX that are of interest at the end. So it should be fun. I'm going to try and give you some actionable things, and that's my plan. So let's get started with the yield. So this language, for those of you guys have seen this language before, right? Basically what it says is if you do something and you lose money, it's your own dumb fault, not ours. So I wish they would let us put the legalese in that language because I think that would be better. But for that reason, but they don't. So there you have it. This is not education, and if you lose money, it's your fault. That's what this says. Feel free to read. All right, for those of you who don't know me, my name is Mark Sebastian. I am the founder and principal at optionpit.com. We are an education and consulting service. We have kind of a range of clients. We work with retail clients, teaching them how to think and trade like professionals. And we also work with funds, asset managers, registered investment advisors, money managers, help strategies. So we'll get, for instance, I'm working with an investment. In addition to that, I think one of the big things that differentiates us from every other firm out there is that we are not educators that work here. We are an education company, but we are not educators. We are traders who teach. So I learned to trade by clerking during the day. And then after work, the guys who were already traders would teach us, would work with us and teach us and spend time with us teaching us how to trade. And then a year of doing that, and I became a professional trader in New York on the American Stock Exchange. So this is kind of that same concept. We took that training program, all the things that I learned in terms of how to be a professional. We kind of spent some time applying it to retail and smaller institutional approaches, and kind of turned that into Option Pit. So that's what we do. In addition, like I said, I run a couple of hedge funds. So I'm in. I have a small volatility fund, and then I'm in the middle of launching my hedged S&P Edge fund. So we're what we call a broad cap edge. So I am basically trying to get alpha on the S&P 500, and then also have a hedging program over the top of it. We expect, both are. We have a 3-year track record on the one, and we're just launching the other. But so you could say I'm managing 1.5 hedge funds. But enough about me. Let's get to why we're here. What you will learn. All right. What is volatility? What is the VIX? The different ways to trade the VIX, ways to trade the ETP, and then we'll do some strategies for trading them that I use, and then I'll take some questions and we can talk. So volatility is a measure of movement of an underlying instrument over a period of time, regardless of direction. So it's variance over a time series is the way I like to put it. The higher the volatility, the higher the movement and or expected movement of the underlying. So when I discuss volatility, and this is the first thing that'll throw people off. No matter how long to expiration, the number is an annualized number. So here, let me pull up Snapchat. So if you look at Snapchat, what I want you to notice is that the options that expire on Friday have an implied volatility of 78.94. That's what sigma represents. And then the regular NOV are 61.63. The NOV 24s are 57.25, and so on. Well, even though this option expires in 2 trading days, this 79% number is an annualized number. So what they're really saying is that Snapchat over the next 2 days will move on a 79% annualized rate. All right, does that make sense to everybody? So it's a little confusing, but you know, I think it's important to understand that everything is annualized. All right, now let's talk about the 3 main types of volatility I look at. So the 3 main types of volatility I look at are historical volatility, which is how much an underlying has moved in the past over a set number of days, 20 days, 30 days, 360 days. The next is realized volatility. Now, realized volatility and historical volatility are sometimes used interchangeably. I like to think to kind of delineate realized from historical. From realized is kind of how much is something moving right now. All right. And then there's implied volatility. And that is how much the market is expecting an underlying to move over a set future time period. All right. So, you know, with realized, the one that throws people off. So think about historical as looking at like HV30 or HV60 or some longer dated volatilities. And then think of realized as maybe looking at a 10-day chart. You know, I would say, you know, a way of thinking about it is that, you know, over the last 20 days, Snapchat's historical volatility is yada, yada, yada. Today it experienced a lot of realized volatility as it was down 20%. Does that make sense? That's kind of how I separate the two. You know, one is what's happening now. One is what has happened in the past. All right. So what makes trading volatility different than trading a stock? And the answer is over the long term, we know where implied volatility of a stock or index is going to go. We do not know where the stock price is going to go. And the main concept is implied volatility has mean reverting characteristics. So here is a chart of Apple. Does that appear to have any type of mean price? Yeah, the answer is no, right? You know, you'll have your Elliott wave people tell you there's some weird thing there or some crazy you know, you'll have somebody else tell you that you know, this doji is saying this doji, and if this doji happens, there's some mean reversion of this doji. But in honestly, you look at that and there's no mean. It's just a 200-day moving average that's been going straight up and a 50-day moving average going straight up. Now, this is VIX APL. Now, what is VIX APL? VIX APL is the VIX of Apple. Now, I'm going to tell you, when I look at that, that appears to have a mean price. All right, you see the mean price there? And you can tell because look at that gray 200-day moving average. That thing is flatter than a pancake. And even the 50-day has a meanderingness to it. All right, and that's really, I think, the key is that volatility does in fact mean revert much more quickly in stocks than in indexes. So the thing to remember is a stock price can go anywhere and stay there, and volatility can go anywhere, right? It settled into the 80s in 2008, and it can go super low, as in it touched below 9 last week. So volatility can go anywhere, but it can't stay there. It will revert back to a mean over time. And understanding that will help you with some buy-sell decisions. However, most traders think mean reversion is an instantaneous thing. Oh, VIX is low, better buy it. VIX is high, better sell it. And that's just not true. Vols can stay extremely high or extremely low for very long periods of time. All right. look at where we are, from kind of the middle of 2012 to the middle of 2014, volatility was really low. And then since July 2016, all the way to where we currently are, implied volatility has been really low, right? We've had all of these, we've had more nine handle settles in VIX in 2017 than all other years combined in the past. All right. Now, the key is that, and then, we saw in 2015, volatility stayed high for 6 months. In October 2016, it stayed high for 3 or 4 weeks. In 2011, it stayed high for 6 months. And in 2008 and 2009, it stayed high for over a year. So it's important not to have a recency bias. Don't think, well, vol's low, that way it's going to stay there. Or, even more importantly, don't think vol's been high, so it'll stay there. Neither is those the case. They don't have to do anything. VIX could be around 9 for another year. It could be done tomorrow. I don't know. I'm not going to try and predict it. All I know is that volatility reverts to itself as well. So when vol is low, it tends to stay low. And when it's high, it'll pull higher. So let's talk about the VIX. All right, any questions on kind of what volatility is, its mean reverting characteristics, anything like that?
Does anyone have any questions on that? No, I think we understand the point. It's a good one. We do have one question.
All right.
Would you like the question from the lady was, can you take interruptions for questions, or would you rather say them to the end, or breakpoints?
Can you repeat that?
I'm sorry?
The question.
Ask any questions at the time that you are speaking. Or do you want us to wait until after?
She's asking, would you prefer to save the questions or take them as we go?
Oh, I mean, so when I take these breaks to take questions, I'll take them now. I'll take them. But when I'm speaking, then
Yeah,
no.
we might as well wait for breaks. But we have a break right now. If you have a question, so you can go back.
Yeah, or we can do them at the end. It's up to you guys.
Okay, go ahead.
All right. Just because all this builds on it, so when I stop, those are like little sections that it's really important to understand. Because you're just going to get more lost as I move. That's my point. All right, so let's talk the VIX. The VIX is the SIBO volatility index. In fact, I should change this because they're no longer the SIBO. They're SIBO. I don't know if you heard this. They paid some firm like a high 7-figure contract to tell them to stop calling themselves the CBOE and start calling themselves SIBO with a lowercase BOE. I could have come up with a better rebrand in a fever dream. I'll be honest. But anyway, it's the SIBO volatility index, and the purpose of the index is to gauge the buying and selling of options in the S&P 500. It gauges what I call the cost of insurance. So the idea is that really the VIX is just a how expensive is it to buy car insurance gauge. And the idea is that when there's more buying over selling, generally the market is trying to buy protection. And when there is more selling than buying, the market is not seeing protection. So VIX up, cost of insurance is up. VIX down, cost of insurance is down. So I think the big difference in terms of insurance cost is relative to like car insurance, is that car insurance gets to be cast over a very wide group of people buying car insurance. Whereas the VIX is what? One person or one index that measures all the value of car insurance everywhere. And so that's the big difference there. All right, so you don't have kind of the reason why the VIX moves around so much is because there is only one gauge. It's not like there's actuaries selling to millions of people all these different these different levels. All right, so similarly, S&P 500, you can't trade the VIX. Now, are you guys aware that you can't actually just trade the S&P 500? You can trade S&P 500 futures. You can trade the SPY. You can trade index funds, mutual funds. You can trade what's called a basket. It's where I push a button and the entire weighting of the S&P goes out in an order for stocks. But you can't just push a button or call a broker and say, buy me the S&P 500. He'll say, well, this index tracking fund tracks 99%. Just doesn't happen. All right, so the VIX is essentially an estimate of implied volatility on the S&P 500 that has a constant duration of 30 days. Constant duration means that it attempts to constantly mimic a portfolio with 30 days to expire. All right, so basically the VIX today had 30 days to expiration. Tomorrow, the VIX will have 30 days to expiration. The following day, the VIX will have 30 days to expiration. So the VIX is always 30 days to expire. So that VIX number is a 30-day annualized volatility. So right now, where did the VIX settle today? 970 something, I want to say. 972. Does that sound right? Well, I'm looking. It settled 978. Sorry about that. So what the VIX is telling you is that over the next 30 days, on an annualized basis, the market is expecting the S&P to move 9.78%. So if the market expectations were as they are for the entire year, we would expect the S&P from this time next year to be about 250 points higher or 250 points lower, about 66% of the time, 68% of the time or less. We'd expect it to be within 500 points about 95% of the time, and within 750 points about 97.5% of the time. The VIX is quoted as a price, but it's actually a percentage. So volatility, despite the fact we don't really speak of it that way, it's always a percent. So really, 9.78 for the VIX is 9.78%. Here's the VIX in the last 3 years. And what I want you to notice is that, yeah, it's been kind of on the move lower, but we do have periods where it can be really high. This is kind of, this is August 2015, and it's kind of stayed higher, elevated, above 25 for the most part, all the way through February. You know, between February and August, the average VIX price was above 20. About 20, 23, 24. But since then, that average VIX price has been about, call it 13 or 12. And this year, that average VIX price is below 11. The VIX negatively correlates with the S&P. So when the S&P is up, VIX is down. When S&P is down, VIX is generally up. I mean, that makes sense, right? As generally, when the market sells off, volatility does increase. There's also the nature of similar movement against a lower number. All right? So think about it this way. 5 years ago, the S&P was around 1,000. So a 10-point move in the S&P was how much? And if you don't know the answer to this right now already, you should stop trading options. It was 1%. Right? So then if now we are 1,500 points higher, how much is a 10-point move in the S&P now? It's about 0.4%. So what you have is similar movement on a much more expensive index. And that actually has a natural ability to tamper volatility. If you look at stocks, high-priced stocks have lower implied volatilities than low-priced stocks. That's about the only thing that will, over time, adjust some of the mean reverting characteristics of implied volatility. All right, so now there are also a couple of features. I'm not going to get into the calculation, but there are some features of the VIX calculation that cause it to increase in a sell-off. There are. So one thing I do is I really watch for breaks in correlation. So when the S&P is rallying and the VIX is rallying with it, I'm almost always that almost always tells me to buy more protection and or to unwind whatever long I'm carrying. And then other way around on sell-offs, when volatility stops falling, when volatility stops rallying as a sell-off is happening, that's almost always a sign that the sell-off is over. All right, I literally called. I mean, I don't know how many of you people are Kramer fans. I do some freelance writing for the street, and he knows I know VIX, so he will ask me to do VIX stuff. And it's been pretty phenomenal just how easy it is to look at VIX and know that something is about to happen or something is done happening. All right, any questions on VIX before I move on?
Can you hear me okay on this portable mic?
Yeah, I can hear you.
Okay, let me just attach this slide.
Hi, I'm new to this, so I'm wondering
Welcome.
what is the lower line that you are speaking of?
Which lower line?
Well,
Oh, in here?
When you are speaking, you are consistently saying the lower line.
Is in like the charts I was looking at?
Yes.
This one or this guy?
I think the one up that you just showed.
Okay. All right. So you see the blue line here?
Yes.
All right. This is the 200-day moving average. And the red line is the 50-day moving average. And what I want you to notice is this blue line here is the 200-day moving average, and it basically just goes straight up, right?
Okay.
And the red line does the same thing. That doesn't have any mean reverting. Does that look like it has an average? Or does that look like this goes straight up? Right?
It's kind of going, to me, if you put it like that, it's going straight up.
Yeah, that's exactly right. That's what it's doing. Meanwhile, look at this. Do those appear to be doing anything?
No.
No. They're, I'll give this the closest thing. The 50-day moving average of an implied volatility is the closest thing I've ever seen to looking at like a predictive Elliott wave. It's amazing how good Elliott waves are telling you what just happened.
Okay.
Do you understand?
Yes.
Awesome.
Other question is, if there's a continual 30-day period, why can't you hold to buy or sell?
Well, because the VIX uses the continual 30-day period is the VIX calculation. Here's the problem why you can't just buy or sell it, is that it is an index of about 1,000 options. So you'd have to go in and buy 1,000 options at once, and then you'd have to be readjusting that option position every day as one contract becomes more weighted and another contract becomes less weighted. And so, if I buy a basket of the S&P, I'm making, a couple of tiny stock trades every day. So there's not a lot of friction there. You ever try to trade 1,000 S&P options at once? Your cost of business would be insane. Now, the closest thing that actually, there is something that trades over the counter, which is over the counter is where kind of professionals trade with and without the exchanges. So they'll use clearinghouses, but they will not actually put it up on an exchange. It's, basically I call you and you and I make a trade. It's like the garage sale of trading, if you will. There is a type of trade called a variance swap that is very close to what the VIX is. And the VIX basically measures a 30-day variance swap.
So it's sort of a derived calculation. So
it's a derived calculation off of about 1,000 things. So right now, here, I'll show you kind of where VIX is pulling itself from right now. So the VIX has 30 days to expire, right? So it's going to look at the 2 weeklies that are closest to 30 days to expire. So it is going to be looking at the it's going to be looking at the December 6th weekly and the November 29th weekly. I'm sorry, I'm looking at VIX, SPX. Pardon me. It is going to use the 2 Friday weekly expirations that are closest to 30 days to expire. So it's going to be looking at it's almost entirely the December 8th contract. So it's, I believe, the December 1st. There's maybe a tiny bit of the December 1st contract that expires this Friday left in it. And then the rest is all December 8th. And then tomorrow it'll be December 8th. And then it'll start being the 8th and the 15th. So it's using these contracts. But these contracts, take a look at how many strikes. It looks at values. Here's December 8th contract. Sorry. So it looks at every December 8th contract that has a bid of at least a nickel to pull a calculation. So that starts at 1,700 and goes all the way to 2,800. So it's looking at 1,100 strikes to make a calculation. So and these are options, so they're a little wider than stocks, and that's why that works the way it works. Does that make sense, ma'am?
Yeah.
Awesome.
Yes.
Okay. Any other questions from anyone else? Okay.
Excellent questions, ma'am. Thank you.
Thank you.
All right, let's move on. All right. So let's talk about the VIX futures. So the VIX futures are probably the most successful futures product introduced in the last 15, 20 years. They trade out each 8 months, plus there is a weekly future. There are 4 weekly futures. Each month trades independently. All right. It is not like the structure of SPX, which is based solely on carrying costs. All right. So think about it. Right now, do we have different expectations for volatility that in December than we might in January? Yes, right there. Anybody ever heard of December seasonality? Does volatility tend to be lower or higher in December? Right there you have it. Right, and then in January, is volatility tend to be a little higher, or February? Yeah. So there's no, I'm going to talk about this, but because there's no early exercise on these futures, they actually tend to be very indicative of what the market is expecting from that time period. Now, they're all related, right? They have a correlation to each other, all right? But, what do you think the correlation is between the December future and the March future in the S&P 500?
Well, they're going to be highly correlated.
About as close to 1 as you're going to get. All right. Meanwhile, the correlation between the November future that expires next Wednesday and the December future that expires in about 38 days, that correlation is a lot different. Right? That correlation, they correlated about 0.6, 0.7. Maybe worse. All right. November has a much higher beta than December. So VIX futures are in contango more than 80% of the time. Contango, it means that nearer term contracts and the cash index itself are less expensive than the further out months. And it's typically used as a long portfolio hedge. That's the main use. So this is VIX futures in a contango. And this is from last week. And what do you notice, right? You have November, December, January, February. And while you can tell they're related, you can also see that they do not move in unison, do they? I mean, look, December is probably, if these were perfectly aligned, December would be more expensive than it currently is. Guess what they're pricing in? A little bit of seasonality. And now this is backwardation. All right, now what I'm going to tell you about backwardation. How many of you have your fun systems that you have in place? You've got this trading system and this trading system. You've got these rules that apply to this butterfly or condor or calendar or call spread or credit spread or your candlestick trading, futures trading. How many of you people have, what you could call a system in place?
So how many people, let's ask the question, are trading some kind of a system? So I'd say we have maybe 40, 50% of the room.
All right, now, when you see this structure in VIX futures, your system is garbage. It's not going to work. All right, this is the system killer. What this basically represents is that value and statistics no longer matter, and this is what we call the sign of panic. When VIX futures are in what is called backwardation, that is when the market is under extreme duress. So all of those, well, it shouldn't drop this much because of this, it shouldn't do this much because of this, and when this happens, I'll do this, they're going to go out the window. The way I would think about it, and we've seen this, buying strategies, selling strategies, none of them tend to work. The systematic strategies tend not to work when VIX is backward, which is what this is. So, and some of you might not have been trading in a period of time where this actually happened for more than a couple of days. But if you look at August 2015, right, when China blew up, did any real option strategy work over that period of time? No. Everything got kind of gunked up. So the way I always describe it is we all know, what do you want to do with stocks? You want to buy low and what? You want to sell high, right? So that is not the way VIX works. With VIX, you want to sell low and buy lower, and you want to buy high and sell higher. When VIX is high, it tends to stay high and will keep going higher. When it's low, it'll stay low. Their volatility is correlated to itself. It's about the only thing that statistically correlates to itself on a daily basis. There are entire funds that run on what's called autocorrelation. All right. So we all understand when this happens, just be aware that your plan's going to have a problem. And this is your sign to GT at HO, as in get the heck out. Although on the floor, we usually replace that H with an F, I'll be honest. So now let's quickly talk VIX options. We got a lot to cover here, guys. All right, VIX options are the most successful option product introduced in the last 20 years. They trade out about 8 months, including 4 weeklies. Each month, again, trades independently, like the SPX. And when you think about VIX options, the underlying is not the cash index. The underlying is the future. So even though the VIX futures and the VIX options expire into what is essentially VIX, until the final day of trading, the underlying for VIX options is going to be the VIX itself. It's going to be VIX futures. It's going to be like, so right now I'm carrying a bunch of November 11 puts. My underlying is the VIX futures, not the options. VIX futures are about 1080. The VIX itself is about 980. So there is a difference between that underlying of a full buck. All right, I'm going to teach you a little trade that I've been doing that makes some sense. So let's talk characteristics. VIX options and futures are European exercise. That means they cannot be exercised early. They have a unique settlement. And I'm going to start out by, if you're new to VIX futures, never take, or options, never take them into expiration, ever. At 30 days to expiration, they'll typically move at a beta of about 0.5 to 0.6 to VIX. As time passes, that beta to the VIX cash increases. On Tuesday, which will be the day before November expires, that beta will be almost 100, almost 1. All right, so let's take a look at the activity. This is from a few days ago. And what I want you to notice is look at that open interest. Look at the average daily volume. The average daily volume of the VIX options is greater than most open interest in individual equities. Its open interest is really only rivaled by about the S&P 500, maybe Apple, maybe SPY. It's like one of the most active contracts traded in the world. All right. So now recall that I said VIX options, the strike, the underlying is the future, not the cash. So my options, each month has its own underlying. Well, another reason is every time Donald Trump opens his mouth, 10,000 VIX futures trade. Ed Tilly, the CEO of SIBO, should legitimately set up a PAC to keep Trump in office in order to keep VIX futures trading. That's a joke. But, so take a look at November versus January. What is the at-the-money option for January? Or February? What's the at-the-money option for February, so we're not confused? February is right here. 14. 14. What is the underlying for April? 15. What is the underlying for November? 11.5. So every month has their own at-the-money option. So that's what I mean. They're related to each other, but VIX futures contracts are more like first cousins, whereas S&P contracts are like twins. Right? Back in medieval England, VIX futures could have married each other. S&P futures could not have. Yeah, and the green is the real cash value, correct? You like that medieval feudal reference? So, you do have, yeah. So if you haven't been to VIX Central, which is where I pulled this, this is a great resource for just seeing how the VIX futures look, and for seeing how they've looked historically. It's a great website. All right, so let's talk about how to trade short. Now, there are ways to trade long, but long, unless, again, you're buying high and selling higher, tends to be a losing proposition. So trading short is becoming kind of the popular trade. It's maybe a little crowdy, but not really. And the best way to trade VIX as a short is to buy long puts or put spreads. So I'm going to show you something that's going to blow your mind. All right, and this only exists in VIX. All right, so what do I like about a long put? It simulates a short future and has capped losses. It will have some time premium. So if I want a little less time premium, maybe I'll use out of the money. I'll use spreads, and I'll use what's called a convergence trade. And I use that during periods of contango, which we've been in for a year. And I'm betting that the future will grind lower toward the VIX cash. So take a look here. All right, if I sell a September future at 1440, and the VIX stays, in this case, 1140, where will that September future settle? And if anybody says anything other than 1140, you do not understand the nature of expiration. So yeah, even though the September future is 1440, if VIX stays here, this future has to lose $3. That creates a trade, doesn't it? Well, let's take a look. So this is from last week. I want you to take a look at Jan options. Right? So in this case, the VIX is trading around a little below 10, 985. And the Jan future is trading 1332. All right, well, what is the price? What is the price of the January 12th put?
Well, it appears to be 0.95.
Yeah, it's 95 cents. All right, so now, and let's make it even easier. Let's make it $1. Right? Let's just say we bought the offer. All right, where VIX right now is 985. All right, 985. Everybody remember that. So what is 12 minus 985? $2.15. All right. So in any other product other than VIX, what is the minimum price that the January 12th put would be trading? $2.15. That would be the absolute low. Anything below that, it'd be an arbitrage. But remember, the underlying for here is the future. But it expires into cash. So I can buy the January 12th put for $1. And if the VIX just stays here, how much money do I make at expiration?
Okay, we had some answers. Go ahead. $2, do you say?
Yeah, it'll be worth $2.15. So should I be able to buy an option for $1 that is worth $2.15 at expiration? In any other product, would I be able to do that? Can anybody think of one? No. And that is specifically related to mean reversion. When the VIX is at 985, everybody assumes it's going to get higher. So they assume mean reversion. However, low vol does what? It correlates to itself. So because of that, I can buy a January 12 put for $1, and I would make $1.15 at expiration. And guess what? I have better than 50-50 odds that that put will win. I might not collect all $1.15, but when was the last time we had a settle above any type of settle above 12 or 11 for that matter?
A long, long time.
Yeah, and yet I can buy that Jan 12 put for $1. Right? Let's see what that that 12 put would be worth, you know, and we can get a good idea of how that's going to change by looking at the November 12 put. How much do you think the November 12 put that expires? The November 12 put expires a week from today. So how much do you think that November 12 put is worth? If you had to guess, the future is 1090.
Virtually nothing.
It's worth $1.40.
Because it's already in the money.
Yeah, it's in the money. So the VIX just sits here. So if I buy this put for today, that Jan 12 put is 95 cents. It's got about 68 days to expire. In 60 days, if nothing happens, we just sit here. It'll be worth $1.40. Have you ever heard, does that make sense for a purchase to have time decay? Have you ever heard of that before? You're buying something and it has time decay. That's kind of unique, right? So this is this is something we do as a group and things we discuss at Option Pit all the time. And these are things I trade within my fund. Like I said, right now, I am long a boatload of the November 11 puts. Some of that is hedged off in other ways. So I don't do anything unhedged, but I'm still playing that edge. All right, so now you're saying, but Mark, I want to hedge. I want to trade long. All right, well, if you're going to buy the VIX, then the way to do it is to buy a vertical spread because you can get great bang for your buck on vertical spreads. All right, and that's because of skew. All right, so think about it this way. A lot of people use VIX options to hedge, but because they're long they're long the stock market. All right. So if I'm long the stock market, do you think I'm really worried about the VIX going to 12 or 13? If I own the S&P 500, am I going to start running for the hills that the VIX goes to 12 or 13?
No, because you're bullish.
Yeah, it's just that's like normal range trading, right? That's the way you'd expect. A 1% down moves to get 2% up, right? However, am I worried about the VIX going to 20 or 25? Yeah, right? Why? Well, here we are at 970. If the VIX gets to 20, is something really wrong? Are we down more than 1 or 2%? What do you think? Right. So if the VIX gets to 20 or 25, is there a problem?
Oh yeah, well the market has crashed.
Yeah, people are worried, right? So what happens is that most guys that are hedging using VIX options, they buy the 20s, the 25s, the 30s, and they kind of ignore the near the money stuff, except for the guys that are doing some very, very specific things. So what do you think if there's kind of weird demand on the wings and little demand near the money. What do you think that's going to do to skew or curvature? What do you guys think?
Anybody else care to answer this time? Well, it's going to greatly increase the
yeah, it's going to have a really steep skew, right? So VIX calls have a crazy steep skew. So what I want you to look at is this is a December call spread from last week, and I could buy the 12-20 call spread or the 12.5-20. So let's just take a look at the 12.5 and the 20. So I'm getting 7.5 points of hedging from 12.5 on. And this is great for like a trade for income traders. The only guys that really will hedge using kind of near the money options are guys that are selling premium. You know, and so look, I can buy a VIX 12.5-20 call spread, and I can pay less than $1. Now, if you're a credit spread seller, are you going to be out before VIX gets to 20 unless it gaps there? I need to move rows. All right. My 14-month is going to bed, folks. Everyone say goodnight. So I think the key is that you know, this I'm betting $1 to make $6.50, and that's going to be a really nice hedge for a income portfolio where really implied volatility is what's going to determine my my profitability. So this is a way I would hedge. Make sense?
Absolutely.
Awesome, right? All right. So any questions about VIX or VIX options, or should I move on so we have time to get to questions?
Yeah, here's Mark.
Yeah, the slide that you just had up, could you go back to that? So are you ratioing that? I see one.
Oh, no. These are two entirely different trades that are unrelated to each other.
Okay.
That 20 lot is related to something else. I was just pulling, you know, I want you to look at the arrows, not the one.
Okay.
Now, if you take a look at my VIX position, this is not my fund. This is just my PA. But I've got all sorts of kind of just screwy stuff in here. So ignore what you see, because what you don't see is that 20 has another 20 here.
Okay. Okay. That's it then. Thanks.
Okay, we got another question. Let me get over to this person.
That would be a crazy ratio, 1/20, wouldn't it?
Hi. Can you not do a approximate and a decimal begin and stop or what?
Can you repeat that?
Can you not do a approximate line and a decimal line for a begin and a stop?
In what, VIX?
Yes.
You know, the problem is that, like I said, the underlying is the VIX futures. So you could get a weird movement in VIX that doesn't really even affect the VIX futures. So if you're using your VIX underlying to hedge, to decide your VIX trades, you could end up with something that is very, very, you'll end up getting pulled this way and that for no reason. So for instance, the VIX this week has ranged from 11 all the way down to about 9.5 today, and the range in the December future has been 20 cents. It's gone from 12.10 up to 12.30, 12.35, and then settled here about 12.15 today.
Okay, so correct me if I'm not understanding this right, but if you do a approximate for a stop and a decimal for a begin, I mean, that's your line as to where you're commanding it to stop so that it doesn't go past that. And okay, so how is it going to pull you?
It's really sort of an animal unto itself. You know, these options on VIX, the derivatives. So I don't think you can really, you know, analogize it to a more conventional trade.
Yeah, well, if you use the VIX futures as the underlying instead of the cash index. So if you're setting up trades and you want stops and things like that, then you have to set your stops according to price levels in the VIX futures and not in the cash index. If you do that, then it will work. But if you try to use the VIX itself, because of kind of the tendency, especially for longer dated stuff, you know, like I said, this week the VIX has had a 1.5 point range, so it's moved about 15%, and the December futures had a 20-cent range. So, you know, if you said I want my stop out at, you know, if the VIX goes to 11, I'm assuming that means that the December future goes to 13, so I should stop out. The only problem is that the December future moved 20 cents, so you did a trade for no reason. So if you want to use stop orders and buy stops and limits and things like that, then you have to be used the price component of the VIX futures. And the good news is most brokerage firms have a VIX future you can price off of.
Hey, Mark, I know that you have to go fairly soon, right?
Yeah, I can probably stretch it to 7.
Super.
Or 8 o'clock your time,
Super.
7 o'clock mine.
Super. Because we want, I do want to ask you about your company a little bit, so please be sure to leave 5 minutes for that.
Yeah. All right. Let's get to the stuff that you're gonna like about VXX. So, as trading in, and so I should be able to wrap up in the next 10 minutes.
Yeah.
So as trading in the VIX futures has become more and more actively traded, each of these ETNs or ETFs has stated purpose. However, the term structure of VIX futures has many unintended consequences. Now they talk about what they are, but you know, that's not what they were going for. So you guys know who King Sisyphus was? It's a Greek legend.
He's always rolling up the hill.
Yeah, it's the guy with the rolling up the hill. And the idea is he rolled up the thing up the hill only to have it fall down. Well, that's kind of how the VIX futures trade. So VXX, or the VIX ETNs. So the VXX is the iPath S&P 500 short-term volatility futures ETN, and attempts to replicate being long VIX futures with a constant duration of 30 days. So it tries to be, you know, makes sense, right? VIX has 30 days to expire. Why wouldn't you want a constant future with 30 days to expire? Totally makes sense, right? The intent of the fund is allow traders to get long or short, near-dated forward volatility in a exchange-traded product instead of something instead of having to go into futures. You know, the nice thing is I can call my stockbroker and buy a VXX. You know, unless I have futures activated, I can't buy a VIX future. So the way the fund keeps this VIX future, this VIX system working, is that it constantly rolls. So right now it'll be long. It's long November, and then rolling back every day a little bit of its November position down to December. And kind of in overly simplistic ways of explaining it, VXX is running a business where it sells a contract for $15.50 to buy a contract for $16.10. Would you run a business that works that way?
Absolutely not.
No, but that's what VXX is doing. And so here's a question. If you bought a share of VXX on the day it listed, what would your profit and loss be? What do you think? Profit or loss? You bought one share. VIX is lower, right, than when it listed in 2009. So if you bought one share, how much do you think you're down?
Oh, people are saying complete loss.
All right. Well, what do you think one share was worth in 2009?
What did you say?
No cheaters.
$1,200, did you say?
Yeah. The answer is $102,512. So one share is down $102,000. So if you bought 100 shares of this, you lost a lot of money. UVXY, which is the levered version of this, is down close to 20 million.
Okay, so John says, so why do they exist?
Well, they exist because they do work in a vacuum. So if I want to get exposure to volatility today, VXX does a great job. But think about it this way: in the long term, this is what's driving VXX. But in the short term, VIX movement is what's driving VXX. So if I think volatility is going to increase tomorrow or today, I like owning VXX. If I think volatility might increase sometime in the next 2 months, I'm going to lose. Does that make sense? So it exists as an instrument to get long, near-dated volatility right now.
Yeah. Hey, so I guess the question was actually more around how does iPath maintain that position?
Reverse splits. Reverse splits. So anytime it gets below 10, it reverse splits 4 for 1. And UVXY reverse splits 6 for, I believe, 5 for 1 or 6 for 1. No, it's just you have fewer shares at a higher price.
Okay. So how long can they keep doing that?
Forever. Actually, the bond is going to run out soon, and then I think they're going to issue a new VXX.
Very good.
All right, there you have it, folks. Never VXX. Don't buy and hold. UVXY, really don't buy and hold. All right, so the answer is VXX is really slowly rolling itself to zero and should never be held more for a few hours if futures are in contango. It's still a really good volatility day trading product. And what if futures are backward? What do you think is going to happen? What if I'm selling something at 1610 and buying it for 1550? The wind's going to be its back. So believe it or not, it can go through periods of time where it makes a lot of money. It just quickly goes away. So it's a decent hedge against falling volatility. There are people that have long volatility portfolios. You can hedge using VXX, but I don't like it as a hedge against high volatility. And there's kind of the chart of what it's done in the last few years. You can see all the reverse splits, right? Look at that funness. So here's some different products. So VXZ is a lot less bad than VXX, but it's still bad. And that's midterm optional. That's months 4 through 7 that it owns. UVXY is double levered VXX. So it's way worse. TVIX is double levered, but doesn't have options and is a poorly managed. I wouldn't trade TVIX. I'd much rather trade UVXY. And then XVZ, if you had to buy and hold, if someone put a gun to my head and said you have to buy and hold a vol product, I would hold XVZ. But even then, I wouldn't want to hold it. So now here's what I call my very long-term approach to trading VIX. Or excuse me, VXX. So when VIX is in a normal contango, a strategy that's highly effective and passive is to buy long-term puts. So I'll buy puts that are 12 to 24 months to expire at the money. So if I looked right now in VXX, it's trading, you can see 33.5. Really? If I go to January 2019 and I want to buy an at-the-money option, and I buy the 33s, they're $11. All right, well, I will buy that put for $11, $11.20, and I will or $11.10, and I will forget about it. And then two things. If VXX announces a reverse split, the day before the reverse split, I unload my position. And day 2, rule 2, if the curve begins to get really flat, if we see that remember your system isn't going to work chart, if that starts to happen, then I will also no longer trade it. Then I'll close it up and just wait, because those are the times where it may rally a lot and I may get in at a much better price. All Right now, if it gets inside, if it hasn't reverse split and you're inside of, like 3 months, kill it and roll back. It's a really passive strategy, one I use in, in IRAs, things like that. Right now, I'm guessing we've got people that are want more edge, that are active traders. So here's a trade that I also do, and I use this in the hedge fund. I'll buy VXX at the money options with 2 to 3 weeks to expire. Every time the options increase by 50%, I roll down to a new at the money option. I use the same amount of cash. So I pocket cash, and then I roll to a new at the money. And if inside a week, I roll down and out. All right, and because I'm pocketing all this cash, that kind of is the risk management system. If I am going to be if I want to increase my size, well, guess what? What did I show you how to do earlier in the VIX options? I showed you how to make 6.5 to 1 on a long call. All right, so if let's say I buy 10 VXX at the money puts for $1 with 3 weeks to expire, and then I buy 2, and then let's say I buy $1. How much did I spend if I buy 10 of them for $1? I spent 10 grand. All right, now, if I wanted to, how much could I lose? 10,000. All right, so what if I buy 2 of my VIX calls? My VIX call spreads that I can pay less than $1. I pay 95 cents. Well, then I can make 13,000 on those. I'm not going to try and make that. But if volatility explodes, I now have a hedge on. And guess what? On my 10 lot, if I sell those at $1.50, I made 5,000. How much did I spend on my hedge? 2,400. And guess what? I can still leave my hedge on for my next trade. So that's my VXX trade that I do. I do this pretty actively. I also do it in UVXY. All right, so if you apply the same dollars, the hedge builds itself. You can also hedge off the risk in S&P, which I do, or in VIX, or something. You can do SPY puts. There's a lot of people that like to buy puts in SPY and buy puts in VXX at the same time. And you can win twice. All right, so this was a trade that I had done Monday the 23rd. I'm out of it now. I'm out of it now. But I did the 35 puts. I paid like 182, I think. Things didn't really go my way. Vol's been kind of, VXX has been really bouncy. It got as high as like 38 and as low as 36. But here we are, a week to expire. And guess what? I still made 10 cents and everything went wrong. And so, this is a trade that I did that wasn't great, but I still managed to make money. And that's the nice thing, is that even when they don't go perfectly according to plan, most of the time they still win. And then here's the inverse ETNs. Now these are also, some people like these as set it and forget it. They have daily tracking issues, and they typically underperform being short the vol ETNs if you keep them kind of dollar neutral. However, XIV is the inverse of VXX. It's great, but has had some really bad sell-offs. SVXY is an optionable version of XIV, and ZIV is the inverse of VXZ. It's never had some of those crazy sell-offs. So what I want you to look at is, yeah, XIV looks great this year, right? Looks great this year. But take a look at some of these really nasty sell-offs it can have. You can lose a lot of money very quickly in this name. So, for instance, people think they're so smart owning XIV right now. If the VIX makes a run to 20 over a day or two, XIV at this point time was 112. It'll be like 70. It'll be all the way down here. A little follow through, and it could get all the way back into kind of these levels again. So XIV can lose money fast, which is why you can own it, but you have to be diligent. All right, so in summary, I think you get VIX contracts have unique stuff. Each has their own characteristic. IV and VIX are correlated. Bear and bull plays have their own structures. VXX, they're great stuff, and we got the inverse ETNs.
Super. Well, you've been extraordinarily generous, Mark, throughout your career, actually, in terms of option pit, and I know you did expiring monthly and other things too for the general good, and you were very generous in telling us so many details.
Yeah.
Of your own trading. And Michael, we don't have long because we have to let him go.
I can take a couple of questions if you guys have them.
I'm sorry. There was a paragraph that you were talking about almost before you ended, where you were saying you did an option. You may do an option with hedge. Let's see, hedge with SPY and something.
Oh, that was the VXX. Yeah, right here.
Okay. That's
it was the what I was saying was, if you're not taking cash off the table and you really want to ramp up your size, when you first start ramping up your size and you haven't started taking cash off the table, institute a hedge.
Okay.
Right? Because invariably people have a system that works, then they strap it on with a lot more capital, and what happens?
Thank you. Thank you so much. We really appreciate it.
No problem. Any other questions or anything before I run out?
Final question? Now we're going to continue here. Don't
All right,
leave the
great.
room.